Brad Williams, Frugal Finance, a brief overview. Introduction into exchange-traded funds. Exchange-traded funds, ETFs, are SEC-registered investment companies that offer investors a way to pool their money in a fund that invests in stocks, bonds, or other assets. In return, investors receive an interest in the fund. Most ETFs are professionally managed by SEC-registered investment advisors. Some ETFs are passively managed funds that seek to achieve the same return as a particular market index, often called the index fund. The S&P, for example, or the NASDAQ, or the Dow 100. It could be any number of indexes. The MSCMI, Morgan Stanley Commodity Index. While others are actively managed funds that buy or sell investment consistent with a stated investment objective. ETFs are not mutual funds. Let me repeat that. ETFs are not mutual funds, but they combine features of a mutual fund, which can be purchased or redeemed at the end of each day at its NAV per share, with the ability to trade throughout the day on a national security exchange at market prices. Before investing in an ETF, you should read its summary prospectus and its full prospectus, which provides detailed information on the ETF's investment objective, principal investment strategies, risk, costs, and historical performance. Now, the difference here between an ETF and a mutual fund is cost. I mean, there's about 3,500 to 4,000 different ETFs out there. And I can't state the philosophy or the cost associated with each one of these funds. You can go to FINRA. I'll leave a link up here to their fund analyzer, and I've introduced it many, many times. But I'll leave a link. You can go in there and you can type in ETFs, or you can look at an ETF fund by name, and then it'll give you the cost breakdown. But I suggest you go and find the prospectus. In other words, if you have a brokerage account, you should have access to the ETF prospectus. Take a look. The reason being, you'll see the costs. You can compare those to the mutual fund, and it'll be similar. For example, if you look at the S&P 500 as an ETF versus a managed, from a mutual fund perspective, a money manager doing the exact same thing, look at the cost. And what you're seeing is, it's called parity. Mutual funds are being pushed aside because they're expensive for you, the investor. What they're doing is they're actually converting over into ETFs. Why? Well, because they know from a competitive standpoint, they're losing cash flow. In other words, people are just pulling their money out. Smart investors are going, well, why am I paying you 3 times the amount that I can get for an exchange traded fund, and the portfolio is the same? How do you know what the portfolio is? You have to look at the prospectus, and it'll give you an idea of the investment objective and its current top 10 holdings, maybe top 20. Leave any comments. Brad Williams, Frugal Finance. Thanks for watching. See you soon.